Hello and welcome to Live Wire Markets. My name is Chris Conway. Today I am sitting down with Roy Keenan. Roy is the head of the Yarra Enhanced Income Fund, and he's going to be chatting to us today about the changes in the AT1 hybrid market. Roy, before we get to the nitty-gritty, can you just set the scene for us a little bit and explain how this part of the market, the AT1 hybrid market, started and evolved, and what its purpose was for both the banks and investors?
I'd probably take an hour to go through the whole history, but to condense it down, it goes back from the start of my career when both Westpac and ANZ got into a bit of difficulty with their commercial lending in the 90s. And I remember working back at JB at that time, we did the converting preference shares. And through time, we've sort of gone through this evolution where we actually have income securities, reset securities, to where we are today with mandatory convertibles. And what hybrids have always done is provided that second source of equity credit. Always be there when the banks are in times of need to convert these hybrid securities into equity. And during the global financial crisis, those hybrids proved not to be equity-like, they were more debt-like. And to where we are today with the securities we've got, they're more equity-like and have that ability to convert to equity in times of stress for a bank.
Roy, you talked there a little bit about how hybrids have evolved and been used. What are the distinct features of AT1 hybrids?
So the ones we have today are a lot different than the ones 30 years ago. Yep. Today, those securities, sit behind what we call subordinated debt, Tier 2, and sit above equity. And the key features of those securities are that they have capital trigger, and that means if the capital of the bank falls to 5 1/8 or 5.125, then there is a potential for these securities to be converted to equity in times of stress to support the bank's equity base. They also have the ability to convert to equity in non-viability. So in the sort of sense of if a Credit Suisse ever happened in Australia, the securities can be converted to equity. And also they have the feature in them that actually they can be missed their coupons. Just senior bonds of a bank, the coupons or distributions are actually guaranteed, right? So they can't miss them. But in the hybrid AT1 market, they can be missed.
Roy, I know you're not a regulator, but I'll ask this question sort of hypothetically. The plans announced by APRA, I know you're across them. What do you think the regulator is trying to achieve with these plans to scrap the AT1 hybrid market?
Yeah, I'd have to say, as a hybrid lover, I'm absolutely devastated and disappointed the market is going to disappear over a 7-year period. Yep. And I think, look, what's really important to understand, I think, is that hybrid securities, the AT1s, whilst they do have those features I mentioned earlier, conversion to equity, we're talking about really good quality credit. So ultimately, the risk of this happening and having a great regulator like APRA can actually, I think, these securities were a lot less riskier than, what was embedded in their features. Right. And ultimately, I think, what happened last year with Credit Suisse and UBS is that you look at, or any other where a bank gets in trouble and there's remediation done to fix the situation, it has to be timely and quick. And I think what APRA has said is that the current way AT1 market is structured, being mandatory convertible to equity, which is a going concern type capital, is just too complicated to sort out a really quick answer. It involves retail, involves institutional, and I think ultimately they've gone from this going concern capital to a going concept, capital sort of structure. And I think ultimately that is to actually solve, because these things generally happen on a weekend and you want it sorted by Monday because you don't want mums and dads queuing up in Collins Street and taking their money out of the bank. You need to establish that confidence in the system. Yeah.
Roy, what does it mean for AT1 hybrids that are set to roll over this year, the immediate problem?
The first thing is that, we originally, when the paper came out in 2023, we were a bit unknown what would happen with the securities in 2025 and 26. And what's been made a lot clearer from APRA in their letter to the banks in December of 24 is that they've basically said if your risk capital calculation is under 1.5%, so virtually the amount of AT1 you have versus the risk-weighted assets you have, then you basically, those banks who are above 1.5% will not be allowed to roll their securities. So in our calculations and analysis of that, we have about $11.3 billion of AT1 being called in 2025 and 26. So what happens from there is that the banks that we see that won't be able to roll their securities in 25, 26 out to 32 will be NAB and Westpac.
Right.
Both CBA, ANZ and Macquarie Bank, and, have basically, they do fall below 1.5%. So there is scope for them to issue. Depending on what you calculate risk weighting assets at, there's probably $1.4 to $2 billion of potential securities rolling in 25, 26. The timing of that is unclear, but APRA has asked the banks to actually put their plans to APRA by 31 March 25.
Roy, another wrinkle, as I understand it, is the reclassification by APRA of AT1 hybrids to Tier 2 capital. Can you just take us through what this means and what the potential impact might be?
So this is all being introduced on the 1st of January 2027. Yep. So from that point, all existing AT1 will be included as Tier 2 from APRA's and the bank's perspective. Yep. That's well and good from the issuer and the regulator's point of view, but from the actual point of view of an investor, like ourselves or anyone out there, these securities essentially have only changed in nature by one thing, and that's because APRA has said all the securities post 2027 have to be called. Right. So what it has done is remove that unknown of what we call extension risk, and we have surety that these securities have an end date. What doesn't change with the change to these securities becoming Tier 2 from a APRA and issuer's point of view is that these securities are still issued under a PDS. They still have those features I mentioned earlier: capital trigger, non-viability, and the ability to miss coupons. So I think investors need to think about that when comparing the risk reward in these securities and how they're priced versus other instruments in the bank capital structure.
Roy, you've touched on it there, but what should investors be considering as the AT1 market rolls off and they look to deploy capital? Yeah,
look, I think the most important thing is to think about risk reward. This market doesn't disappear overnight. It's in a gradual decline, and the last security is going to be called back in 2032. So if I think about it from our perspective, we still see it as an investable market. We'll be a buyer and seller in that market. I think you've got to be really understanding about what the alternatives are out there, being very mindful that if you're chasing yield, you've got to be really thinking about the risk that is set up against that yield. And I'm just worried, especially for retail investors that don't have that sophistication, they probably might go into traps that really they shouldn't be looking to do.
And how might they avoid those traps?
Perfect thing is to come to a fund manager like us. Yep. I mean, whilst this is disappointing for the hybrid market, I think this is really good for a fund manager like us. We've got a long history of producing good quality returns. The AT1 market is only just one segment of, like my fund, the Yarra Enhanced Income Fund. We still have, other ways to generate what we think are quality returns. And just recently, we've seen a really big resurgence in the corporate hybrid market. I think particularly that's one market which will be an alternative for the AT1 market disappearing over time.
Roy, again, you've touched on it there, but with AT1 hybrids being phased out, where else will you be looking for opportunities?
Yeah, look, it's going to be an interesting period. I mean, we're obviously dealing with President Trump coming in, and every day seems to be a different day in markets at the moment. But the actual AT1 market's disappearing, but it's been replaced with the similar amount of Tier 2 market. So the investable universe for us doesn't really change. It's just moving up the capital structure in a sense from a fixed income investor's point of view. So, we see lots of those opportunities. Corporate hybrids, we think we're really positive on that sector. We think that the REIT sector will be one of the sectors that will be issuing in that market. And I think it'll play a really important part in the energy transition. We've just seen, in the last 24 hours, AusNet do a deal. So we think that, if Australia's going to progress to net zero, that's going to be a really big capital task for the energy companies, the transition companies. And we think corporate hybrids, which, they'll play a part in that sort of capital raise and that movement to net zero.
Roy, thank you so much for sitting down and taking us through what is obviously a complex situation. You've explained it fantastically well. Thank you.
Thank you.